I need to tell you something that nobody else in silver content is going to tell you today. Everyone got it wrong. The analysts, the channels, the prediction makers, the experts who told you silver was going to explode when U.S. futures opened on Monday morning, they got it wrong. And I need to include myself in that statement because I had a prediction live in my public tracker, and the market just did something that does not fit the original thesis. Drop tracker in the comments right now. I know that sounds strange. Why would I ask you to engage when I am about to tell you about a potential miss? Because this is exactly why the tracker exists. This is exactly why accountability matters. This is the moment that separates channels that perform confidence from channels that demonstrate honesty. And today, we're going to do something almost nobody in precious metals content is willing to do. We are going to look at what everyone expected, what actually happened in the U.S. market, and what it means for every prediction I've made publicly. Here is what we are covering. 1. The setup, what the market looked like going into the weekend. 2. What actually happened, the real U.S. market numbers. 3. My prediction tracker update, hits, misses, or live statuses. 4. Why the market did what it did, analysis, not excuses. 5. My updated thesis, specific levels, new timeframes. Let's get into it. And I'm warning you, this is going to be uncomfortable. But uncomfortable truths are more valuable than comfortable lies. The global markets are on edge, and if you're not paying attention, you might be missing the biggest story of the decade. We're talking about a perfect storm brewing, one that could send shockwaves through your portfolio and redefine the very concept of wealth. But don't worry, because today we're going to break it all down. We'll connect the dots between escalating geopolitical tensions, a volatile energy market, and the one asset class that has historically stood as a beacon of stability, precious metals. Let's start with the headlines that are shaking the world. Tensions in the Middle East have reached a boiling point. The recent escalation involving Iran and Israel isn't just a regional conflict. It's a spark in a global powder keg. When drones and missiles fly, the first thing to react is the oil market. We saw Brent Crude prices surge, flirting with the $100 a barrel mark. Why? Because the Strait of Hormuz, a critical choke point for about a fifth of the world's daily oil consumption, is right in the middle of this conflict. Any disruption there, real or perceived, sends prices skyrocketing. This isn't just about the cost of filling up your car. This is about inflation. Higher energy prices mean higher costs for transportation, manufacturing, and virtually every product and service you can think of. Central banks, like the Federal Reserve, are watching this with hawk eyes. They've been battling inflation for years, and just when they thought they were getting it under control, this geopolitical bombshell drops. So, what does this mean for interest rates? The market was previously pricing in multiple rate cuts this year. But with the threat of renewed inflation driven by energy costs, that narrative is quickly unraveling. The Fed might have to keep rates higher for longer, or even in a nightmare scenario, consider hiking them again. This uncertainty is poison for the stock market. We've already seen major indices like the S&P 500 and the Nasdaq take a hit. Investors are fleeing from risk, and they're looking for a safe haven. And that, my friends, brings us to the heart of the matter. Gold and silver. For thousands of years, in times of war, uncertainty, and economic turmoil, where have people turned to preserve their wealth? That's right, precious metals. Look at what's been happening. Gold has been on an absolute tear, smashing through record highs day after day. It's not just a knee-jerk reaction to the latest headlines. This is a fundamental shift. Smart money, including central banks around the world, has been quietly accumulating gold at a historic pace for months. They see the writing on the wall. They're de-dollarizing their reserves and hedging against the very instability we're witnessing today. The recent price action in gold is telling. Even when the dollar strengthened and bond yields rose, which would normally push gold down, it kept climbing. This is a sign of immense underlying strength. It's no longer just an inflation hedge, it's a chaos hedge. It's a vote of no confidence in the current financial system's ability to weather this storm. Now, let's talk about gold's little brother, silver. Silver has been lagging behind gold, but that's what makes it so exciting. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically high. But we're starting to see that ratio compress. Silver is beginning to wake up, and when it moves, it can move explosively. Think about it. Silver has a dual personality. It's a monetary metal, a store of value just like gold, but it's also a critical industrial metal. It's essential for solar panels, electric vehicles, 5G technology, and countless other applications that are part of the green energy transition. The industrial demand for silver is robust and growing, while supply is struggling to keep up. We're heading into a structural deficit, meaning we're consuming more silver than we're mining. When you combine this tightening industrial supply and demand picture with the same safe haven demand that's driving gold, you have a recipe for a potential price explosion. Silver is the coiled spring of the precious metals market right now. While gold has been making the headlines, silver might just offer the more significant upside percentage-wise. So let's put it all together. You have escalating geopolitical conflicts in a critical energy-producing region. You have the threat of a renewed energy crisis, which would fuel inflation. You have central banks trapped between a rock and a hard place, unable to cut rates as planned. You have stock markets spooked by uncertainty. And in the middle of it all, you have central banks and savvy investors flocking to the time-tested safety of gold, which is breaking out to new all-time highs. And trailing right behind it is silver, an undervalued asset with massive industrial demand and a history of spectacular rallies. This isn't fear-mongering. This is about looking at the facts on the ground and understanding the historical context. The mainstream financial media might be focused on the daily wiggles of the stock market, but the real story is the tectonic shift happening underneath. It's a move away from paper assets and towards hard, tangible assets that can't be printed into oblivion. What we're witnessing could be the early stages of a major bull market in precious metals, one that could rival the great bull markets of the 1970s and the 2000s. The confluence of geopolitical risk, inflationary pressures, and central bank policy is creating the perfect environment for gold and silver to shine. This isn't about timing the market perfectly. It's about recognizing the trend and positioning yourself accordingly. It's about adding an insurance policy to your portfolio, a hedge against the chaos and uncertainty that seem to be the new normal. The signs are all there, from the actions of central banks to the price action in the commodities market. The question is, are you paying attention? As we move forward, keep your eyes on the energy markets. Watch what happens with Brent Crude. Keep an eye on the statements from the Federal Reserve. But most importantly, watch the price of gold and silver. They are the financial world's canaries in the coal mine, and right now, they're not just singing, they're screaming that something big is happening. The world is changing and the financial landscape is changing with it. The strategies that worked for the last decade may not work for the next. This is a time for prudence, a time for looking at assets that have stood the test of time. The case for gold and silver hasn't been this strong in a generation. Thank you so much for joining me today to unpack these complex but crucial developments. If you found this analysis helpful and want to stay ahead of the curve, make sure to like this video and subscribe to our channel for more deep dives into the markets. Don't forget to hit that notification bell so you won't miss our next update. Stay safe and stay informed. Here's what the actual U.S. COMEX plus CME Globex market action has been showing. Latest live COMEX spot prices as of the most recent session. Gold, Datsun 5177 nose, about 1.05%, recovering, but still below the recent highs above $5,400 earlier in the week. Silver, $84.54, US 1.28%. Up modestly but sharply below recent peaks near $95. Energy and risk signals. Brent Crude, $82.24 barrel, 1.03%, elevated but pulled back from the immediate spike. WTI Crude, $75.09 barrel, 0.71%, signaling continued oil risk premium. Key observation, silver is far below the aggressive gap targets many analysts predicted, and gold, while up, is not behaving in a straightforward, explosive fashion either. This reflects the mixed and volatile character of the market response, not a clean bullish breakout. Prediction number 1, silver, $36 by April 1st, 2026. Status, achieved. Silver didn't just cross 36. It spent several sessions above 90 earlier this week before giving some of that back. This structural bullish call remains validated. Prediction number 2, silver, $102, $105 within 14 days. Target window March 2nd, March 16th, 2026. Current status, silver now sits, per 84 time pips Oz, significantly below the target range. The short-term crisis breakout thesis has not materialized at the expected level or speed. Confidence update, revised from moderate high, moderate. This move remains directionally plausible, but not currently supported by the price action. So where did the market move versus what was expected? Instead of a clean gap and extension higher, silver spiked briefly towards higher levels earlier in global trade, but then pulled back sharply as the dollar strengthened and traders booked profits. Gold hit highs around $5,400 before reversing part of that move. This divergence between expectation and reality is the essence of what we are analyzing now. Let's break this down analytically, not emotionally. 1. Dollar strength shifted. The narrative on March 3, silver plunged up to on 11% intraday as the U.S. dollar rallied sharply, overpowering safe haven flows and pushing metals prices lower. This is a classic risk-off mechanism where dollar liquidity wins out over asset appreciation. 2. Profit booking and volatility. Exhaustion gold and silver hit multi-session highs and then saw significant profit taking, leading to steep retracements. 3. Market interpreting war risk as inflation plus, Dollar safe, haven traditional, precious metal narratives, expect war, immediate metals rally. What the market signaled instead is war risk, volatility spike, dollar strength, asset repricing inversion. This is consistent with complex macro behavior, where the safe haven becomes cash first, gold second, silver third. 4. Physical logistics. Disruption, ongoing conflict has disrupted bullion flows, especially in global hubs, tightening physical availability, even while paper prices fluctuate. This disconnect between paper and physical markets can mute directional moves in futures, while premiums in physical markets actually expand. There are two noisy camps. Camp A, it's manipulation. Blaming price action solely on manipulation overlooks the macro drivers, particularly dollar strength and risk repricing. Camp B, silver is dead. That interpretation ignores that silver did move, just not in the clean breakout fashion many anticipated. It is still above key support zones and historically elevated. The real takeaway? Movements are probabilistic, not deterministic. Expectations built only on war, however, metals up, are incomplete without factoring in liquidity dynamics, dollar flows, and risk repricing. Prediction number 2, updated confidence, silver to trade. $102 before March 16th, 2026. Confidence, moderate, not impossible, but conditional on. Most people watching gold and oil right now are watching the wrong things. They're following headlines, they're reacting to noise. But there are 5 specific variables, 5 that are quietly driving the next major move in commodities. And if you don't know what they are, you're already behind. Let's break them down. Variable number 1, the dollar index. This one's non-negotiable. Gold and the dollar share an almost magnetic relationship. When one rises, the other tends to fall. Right now, the DXY is sitting at a critical level. A sustained move above key resistance means commodity headwinds. A breakdown below support, that's the green light bulls have been waiting for. Watch the Fed's tone. Watch the jobs data. Because dollar direction will set the table for everything else on this list. This one's non-negotiable. Gold and the dollar share an almost magnetic relationship. When one rises, the other tends to fall. Right now, the DXY is sitting at a critical level. A sustained move above key resistance means commodity headwinds. A breakdown below support, that's the green light bulls have been waiting for. Watch the Fed's tone. Watch the jobs data. Because dollar direction will set the table for everything else on this list. Variable 2, geopolitics. This one doesn't care about charts. It doesn't care about technical levels. One headline, one escalation in Eastern Europe, the Middle East, or the South China Sea, and you'll see safe haven demand spike in gold overnight. But here's what most analysts won't tell you. De-escalation signals can be just as powerful. When tensions cool, money rotates out of safety and into risk assets. That hits gold hard. Right now, the geopolitical temperature is elevated. We're watching it closely, and so should you. It doesn't care about technical levels. One headline, one escalation in Eastern Europe, the Middle East, or the South China Sea, and you'll see safe haven demand spike in gold overnight. But here's what most analysts won't tell you. De-escalation signals can be just as powerful. When tensions cool, money rotates out of safety and into risk assets. That hits gold hard. Right now, the geopolitical temperature is elevated. We're watching it closely, and so should you. Variable 3, COMEX inventory and delivery notices. This is where the smart money leaves fingerprints. When registered gold inventories at COMEX drop and delivery notices start climbing, that tells you physical demand is pulling metal out of the system. That's structurally bullish. When inventories are rising and deliveries are low, paper supply is absorbing pressure. Most retail investors never look at this data. That's exactly why it's an edge. When registered gold inventories at COMEX drop and delivery notices start climbing, that tells you physical demand is pulling metal out of the system. That's structurally bullish. When inventories are rising and deliveries are low, paper supply is absorbing pressure. Most retail investors never look at this data. That's exactly why it's an edge. Variable 4, physical premiums, especially in Asia, Shanghai, Mumbai, Hong Kong. When gold premiums in Asian markets are elevated, meaning buyers are paying above spot price to get physical metal, that's real demand. That's not speculation. That's people who want the metal in their hands. Right now, Chinese demand in particular remains a key wildcard. If premiums stay elevated heading into seasonal buying periods, that's a fundamental floor under the price, regardless of what paper markets do. When gold premiums in Asian markets are elevated, meaning buyers are paying above spot price to get physical metal, that's real demand. That's not speculation. That's people who want the metal in their hands. Right now, Chinese demand in particular remains a key wildcard. If premiums stay elevated heading into seasonal buying periods, that's a fundamental floor under the price, regardless of what paper markets do. Variable 5, oil, specifically Brent and WTI. Oil and gold have a nuanced relationship, but here's the simple version. Rising oil feeds inflation expectations. Rising inflation expectations feed gold demand. But oil also signals something deeper: global growth, supply chain pressure, geopolitical risk premium. When Brent is trending up on genuine supply tightness, not just speculation, commodity markets broadly follow. Watch the oil trend. It's not just an energy story, it's a macro story. Rising inflation expectations feed gold demand. But oil also signals something deeper: global growth, supply chain pressure, geopolitical risk premium. When Brent is trending up on genuine supply tightness, not just speculation, commodity markets broadly follow. Watch the oil trend. It's not just an energy story, it's a macro story. Now, here's why this video wasn't easy to make. It would have been simple to come on here and just say gold is going up or oil is going down, give you a number, collect the views. But that's not what this channel does. Every call we make, every variable we flag goes into the tracker. Public predictions, public outcomes, real accountability. No hiding behind vague language, no, well, what I meant was, you can see every call, every result, right there, transparent. It would have been simple to come on here and just say gold is going up or oil is going down. Give you a number, collect the views. But that's not what this channel does. Every call we make, every variable we flag goes into the tracker. Public predictions, public outcomes, real accountability. No hiding behind vague language, no, well, what I meant was, you can see every call, every result, right there, transparent. If you value analysis over hype, drop tracker in the comments right now. It tells me you're here for the right reasons, and it helps this content reach more people who think the same way. Subscribe, turn on notifications, and check the pinned link. The tracker is live. Because in this market, the people who track what they predict are the only ones worth listening to. It tells me you're here for the right reasons, and it helps this content reach more people who think the same way. Subscribe, turn on notifications, and check the pinned link. The tracker is live. Because in this market, the people who track what they predict are the only ones worth listening to. Markets humble everyone. It's a lesson every trader learns, sometimes the hard way. You can do all the research, have the perfect thesis, and be absolutely right about where the market is headed. But if your timing is off, you can still lose. It's frustrating, I know. But here's the thing. Being directionally correct and getting the timing wrong isn't a failure. It's a data point. It's a valuable lesson in patience and execution that you can't learn from a book. Every single trade, win or lose, is part of your education. This is the Stack Guy, and my approach is always data-driven, fully accountable, and completely independent. I'm here to share the real journey, not just the highlight reel. Thanks for watching. I appreciate your support, and I'll update again soon.